Oil prices experienced an unexpected shock on Wednesday, plummeting more than 7% amidst news of a brewing banking crisis that has investors fearing a potential global economic downturn. West Texas Intermediate futures closed the day at $66.24 per barrel, the largest one-day drop since July 12, 2022. These fears are understandable, considering the news that the Saudi National Bank, the largest investor in Credit Suisse, would no longer provide assistance for the troubled lender, and only a week after two U.S. regional banks failed. Goldman Sachs has lowered its U.S. GDP growth forecast in response to the stress being experienced by smaller lenders, noting that such banks are responsible for roughly 50% of U.S. commercial and industrial lending, 60% of residential real estate lending, 80% of commercial real estate lending, and 45% of consumer lending. This drop in oil prices comes as the U.S. Federal Reserve prepares to hold a policy meeting next week. Traders had previously expected a 25 basis point interest rate hike, but now the outlook has changed drastically. Should rates remain at current levels due to the instability of the banking system, aggregate demand could slow, resulting in further downward pressure on the price of oil. In the short term, it appears that the oil market is likely to remain in a surplus. Ed Moya, senior market analyst at Owanda, predicts that this could change, however, provided there are no major policy mistakes made by the Fed. In the longer term, energy stocks may still be worthy investments, if investors are willing to take that risk, due to the strength of the balance sheets of oil giants. Investors will be hoping for more clarity from the Federal Reserve next week, but, for now, the future of oil prices is uncertain with the heightened risk of global economic downturn.